for more on President Obama's agenda. We're joined now by Scott Mather, who runs PIMCO's Global Portfolio Management. Thanks so much for joining us, Scott. Let me ask you a question. We've been focused on treasuries here, of course, which seriously prices have risen since the downgrade. But when we look at the corporate bond market, it's telling us a very different story. We've seen issuance drop off a cliff, and we've seen spreads reach levels not seen since the worst of the financial crisis. What does that mean? Can you give us a translation of what the credit markets are telling us?
Yes, sure. Good morning. The credit markets are basically telling us that there's an economic slowdown that's coming, and it's likely to be persisting for the foreseeable future. So, the credit markets, the equity markets have sensed that, and in many ways, a lot of the fiscal austerity plans that have been put forth so far are exacerbating the situation. It means that growth will likely be lower than many people had been forecasting just a few months ago. And of course, we saw plans laid out in Europe yesterday by Sarkozy and Merkel, which basically outlined a plan to further accelerate austerity measures in Europe. So all those things are bad for the growth outlook and are leading to wider credit spreads and increased risk premiums across the board.
At this point, Scott, is the credit market watching what the president's doing on a daily basis? I mean, there's been talk now of fiscal stimulus. Certainly, the Federal Reserve is doing everything to keep money very cheap here in the U.S., injecting as much liquidity, I think, as is possible at the moment. But is there a vote of a complete lack of confidence in anything the president is saying? Or at this point, are they not paying attention to the president's day-to-day commentary?
Well, certainly the market is paying very close attention to that commentary, but the real issue is how much can be accomplished. Is there any appetite for substantially increasing spending or adding to demand through some sort of fiscal impulse in the U.S. or anywhere else in the developed world? And it seems there isn't. So far what we have is a situation where there's a growth slowdown that's sort of baked in the cake as fiscal spending is drawn down. And unless something is done to dramatically change that, we can be pretty sure that growth will be slowing down in most of the developed world as we head into the end of the year. And of course, we're starting from a very bad place to begin with growth already having dipped down closer to 1% in the U.S. and Europe.
I want to ask you about where you're seeing value in terms of the credit curve right now. Both investment grade and junk bond spreads have widened out dramatically since August 5th, since that downgrade of U.S. Treasury debt. But are you optimistic about either credit class at this point?
Well, what we've been very focused on is balance sheet strength. I mean, going into an environment where we have continually downgraded the growth outlook, one wants to focus on the safest balance sheets. And that's true whether you're looking at sovereigns, at government bonds, or looking at corporate credit. So that means, yes, the focus is on the highest credit quality sovereigns, the ones with the best debt metrics, and the same is true of corporations as well. So high up in terms of credit quality.
So which sovereigns in particular? There's been a lot of speculation about France losing its AAA rating, despite the fact that the rating agencies have affirmed their stance, at least for the time being.
Yeah, certainly France has been given some more time by the rating agencies. It's pretty clear that they've been given at least another quarter or two. But they certainly are one of the weakest AAAs out there. And so, depending on the growth outlook and depending on the various bailout schemes that are envisioned for Europe, France's AAA rating is certainly at risk. But countries that have very strong balance sheets and have very good debt dynamics going forward are the ones we've been focused on, and that's countries like Canada, like Australia, like Germany, and even many emerging market countries, countries like Mexico.
Scott, let me ask, it seems as if Merkel and Sarkozy have put the notion of Eurobond to rest, at least for now, but there's still a lot of speculation that that will ultimately have to be where they head at some point. So what happens if a Eurobond becomes a reality?
Well, that's certainly what many people were hoping for, would be the answer for Europe. But certainly it's a very difficult thing to achieve, as Merkel and Sarkozy told us yesterday. They're basically telling us that that needs to happen at the end of a tighter fiscal and political integration. And so, it's unlikely that a Eurobond, even if one was wheeled out today, would be effective if we don't have that tighter fiscal union. And so far, there's been tiny steps made towards fiscal union, but certainly it's not developing at the pace that many in the market were hoping for. And that's why we continue to see those countries with the weaker balance sheets at risk, and their spreads widening to countries with better balance sheets like Germany.
And then, Scott, here in the U.S., I just want to talk about the Treasury market for just a moment. What goes up must come down and vice versa. At some point, yields along the U.S. Treasury curve will rise. Let me ask you, do you have an idea of a catalyst that would actually make that happen at this point?
Well, at this point, it would certainly change a dramatically different inflation or growth outlook, which we don't see on the horizon. Or perhaps some dramatic change in Fed policy. But so far what we have is a situation where inflation is likely to be falling, where we're going to face weak growth, and where the Fed has told us that the likely response is that at some point they will be buying maybe longer maturity treasuries, or may even adopt something like a QE3 where they end up purchasing more treasuries outright. So all of those things are sort of supporting treasury prices at this point, and there's no end in sight.
All right, Scott, we have to leave it there. Thanks so much for joining us here on In the Loop. That was Scott Mather, PIMCO's head of global portfolio management.